Thank you all for joining. We're so glad to be here with Edie. Edie is our tax expert for our Ask an Accountant series. We can get started with the agenda. We do have an hour here today. We're going to do an intro for 5 minutes so everyone can get to know Edie if you haven't already. And then Edie's going to dive right in with everyone's pre-submitted questions that you submitted on the registration page. We'll go through those for about 45 minutes or so, and then we're going to leave about 10 minutes at the end to go through the live Q&A. And before we get started, I just do have a reminder. SimplePractice does not provide insurance, billing, or legal advice. All views and opinions expressed by the presenter are not those of or endorsed by SimplePractice or its affiliates. And with that, Edie, we'll hand it over to you for your introduction.
All right. Thank you, Cheyenne. Okay, so you are going to be receiving all of the slides as well. So I won't read this to you, of course, but I just want to highlight a couple of things in case you don't know me. So I started out my career as a CPA, and what is important to know about that is that as a CPA, to get my license, I had to be a public auditor. And so I have been able to go to very small companies, even small nonprofit organizations, all the way up to public organizations, and have been able to see their books. Since I've been presenting with SimplePractice, I've been blessed with also meeting a lot of different therapists and how they do their books of the business. So I've gotten a lot of exposure on how people do their books, but I also am really fired up to teach people how to correctly do their books in terms of what's taxable, what's a proper deduction, and all that stuff. So I do have the background to know how to do the accounting. Now, I also have my own counseling practice that is just it's my greatest joy. One of my greatest joys is to have my own private practice. So I am right there in there doing it with you. When I started my own business, it was at the time it was only accounting. I wasn't doing counseling at the time. And when I started my own business as taking on accounting clients, I asked my friend who's CPA, I'm like, what's your best advice for me? And he said, the best advice is whatever you're going to do and teach with your accounting clients, make sure you're doing it in your own business. And that was the best advice. So if I was telling people how to do things in QuickBooks, I was doing it myself in QuickBooks. I would never ask my accounting clients to do something that I wasn't also walking the talk. And it's the same exact thing with my practice, my private practice in counseling. If I am going to ask therapists to do their books a certain way, you better believe I'm doing it that way first. So I am really walking the talk with you. And what we're going to focus on today is about owner's draw, but it's also about best practices for the books of your business. Okay. So we are going to get into it now. So what in the world is owner's draw, and why is there a whole webinar, a whole hour dedicated to just this one topic? So first of all, I want to say that I've been able to see over 1,800 questions that you guys have submitted, and it's been wonderful. But a large number of you have signed up and not even known what owner's draw is. So in your questions, you're like, yeah, I don't even know what to ask. I just am here to learn. And let me just say, you are my people because I do not take it lightly that you are giving me your trust to be able to explain it. And you know that even though you don't know what owner's draw is necessarily, you're wanting to learn. If you think that SimplePractice and myself are wanting to dedicate this much time to it, you know it's probably important and you want to learn. So that is awesome. And I really, really admire that. And I don't take your trust lightly. So I will be very accountable for hoping to teach you what you need to know about owner's draw. We'll fully unpack it. But the reason I wanted to dedicate a whole webinar to this topic was for two main reasons. One was I was seeing a lot of people run personal expenses through their business, whether it was a lot of activity or just very minimally, maybe like as a mistake. And people don't know how to account for it. So I will teach you what happens if you do run some personal expenses through your business. The default, though, is to not do that, but there are circumstances where that will happen. Okay, so I will teach you how to account for that. And the second one is that you want to pay yourself, whether you're a sole proprietor, whether you're an LLC, whether you're an S corp, whatever your type of therapy practice is, whatever the structure is, you're in business to be able to earn some income, to be able to transfer it out of the business. And I will teach you how to do that. Okay, so this is just a little philosophy slide here. And I just want to tell you that I have such tremendous respect for the work that you do, for the work that I do. I have tremendous respect for this industry. And I also treat my business with the utmost respect. And the way that that actually carries out is respect for doing the accounting, mostly taxes, but so much about accounting is more than taxes. By doing the accounting and taxes correctly, or by the book, as they say, you're respecting your practice and you're setting it up for growth and to thrive. By respecting your practice, then you're also experiencing a personal freedom that is really a beautiful thing. So respect for your business emphasizes two main things. One is good budgeting practice for your business expenses. Okay, and I'll teach you a little bit about that. And then two, having a plan for your personal finances. It's really tough to talk about great business practices with your private practice without also talking about great practices for your personal finances. Okay, so problems with your personal finances are likely going to spill over into business problems with your finances. However, the opposite is also true. Really great practices in budgeting and getting out of debt in your personal finances also transfer into a healthy financial position in your business as well. Okay, so this is all in caps, but it doesn't matter what webinar you have seen from my past. I am willing to guarantee that at least once I have said to have your business separate from your personal accounts. So you have to have a business separate bank account for your private practice. It doesn't matter to me how small. If your private practice is a side gig that you only see one client once a month, I still insist on a separate business bank account. Now, if you are an LLC or an S corp, you actually have to. It's by law, you have to have a separate business bank account. But so that's at a minimum, all right? But if you're spending money in your business accounts if you're spending money in your business accounts for personal reasons, so personal items are being spent in that business account, you're not keeping your business separate from your personal life, okay? So paying yourself, though, is a completely separate item than running personal expenses through your business account. So there are going to be two main components that we're going to talk about with owner's draw. One is any personal expenses that are run through your business, but then also how do you pay yourself? So even though they're both coming out of owner's draw, two totally separate items. And I expect you to be able to pay yourself from your business, okay? All right, so I'm just going to give you a little bit of an overview of what is owner's draw. So owner's draw is a balance sheet item. So it is not related to your profit and loss statement or your P&L or your income statement. Those three words, those are all the same term. So if you might recall that I've been telling you that there are three main accounting financial statements. There's the balance sheet, there's a profit and loss, and there's the least one discussed is the cash flow statement. Let's just concern ourselves with profit and loss and balance sheet. And owner's draw is part of the balance sheet. So I got a lot of questions about, hey, I recorded it to owner's draw, but it doesn't show up on my P&L. That's right. It won't show up on your P&L because owner's draw is part of the balance sheet on that statement. So what is a balance sheet? A balance sheet is called a balance sheet because whatever is on the left side of the equal sign, namely assets, has to equal or has to balance what's on the right side of that equal sign. And that's liabilities plus owner's equity. So just to review, assets are what you own. In a therapy practice, what you own is most likely very simplified. It's not that complicated. Typically, therapy practices don't have inventory or anything of that to worry about. So typically, it's the basic assets are your bank accounts. You might have some fixed assets like furniture and some technology equipment, computers and printers and such, if you haven't expensed those. But for the most part, it's really pretty simple. So your assets are what you own in your business. Your liabilities are what you owe. So your owner's equity is going to be your net investment in your business. So what you own minus what you owe. So owner's draw is part of equity. So equity is made up of three main pieces. Your investment in your business. So let's say that you want to start a private practice and you need a lot of, we call it seed money, to start your private practice. So let's say you need to get a website. You need to do some other marketing promotions. You need to get SimplePractice, become a SimplePractice owner, the customer. Let's say you need to get a business license for providing telehealth. You need to get a platform for that and everything. I'm missing another big component starting up. Oh, you need equipment. So you need you need money to maybe buy a computer and printer and office furniture. So you need seed money. Now, it's best to take an amount of money personally that you want to invest in your company and taking one lump sum and invest it into a company. So that would be the additional funds that you invest in your business. Then the other two pieces of owner's equity is your earnings of your business. So that's why they call it retained earnings. So this is where your net income flows into your balance sheet through the equity part. So let's say you make $1,000 in your business 1 year, then that is a part of your equity because that is how much you're earning. Now we're going to subtract, again, this is just for sole proprietorships right now, but we're going to subtract how much you've drawn from your business. So anything that is personal that you are incurring with your business or taking out of your business is a draw from your business. All right. That's why it's called owner's draw. So owner's equity is made up of plus your investment, plus your earnings, and minus what you're taking out of it. So minus your draws. All right. So now we're going to get to some questions that you guys have already submitted to me earlier. And I have grouped the questions by 4 main topics. I definitely am going to go outside the reservation and talk about a few other questions, but for the most part, the main themes are going to be under these 4 topics. So we're going to talk about personal expenses that are incurred in your business. Then we're going to talk about paying yourself. Then we're going to talk about how much do we either incur in our business expenses, how much do we save, and how much do we pay ourselves. And then we're going to talk about a completely separate whole set of questions about S corporations. Okay, so I had several questions about, is owner's draw my income from the business? No, your income from the business, how much you're taxed on with your business, has to do with your income statement on your business. So what you are taxed on, your income, your net income, is how much you brought in for counseling minus your business expenses. And that income is what is reported on your personal tax return. Again, not S corporations, but on your personal tax return. It flows through there, and that's what you pay taxes on. So what you've drawn from your business is not considered a salary. You're paying taxes on your business portion of your tax return on what is your income minus your business expenses. How do I record personal expenses? Okay, first I have to give you the caveat that personal expenses should not be run through your personal account. That's why I say it's a separate entity. Even though you run your sole proprietorship, your business, your private practice through your personal tax return, you think you're one and the same, but we want to keep this completely separate. So it does happen, though, that we have personal expenses that get run through our business account. So I commonly hear like, oh, you know, I bought something. I bought let's just say Amazon. I bought a lot of things through Amazon, and only a couple of them were personal, but those were personal. So we have to split that transaction into what was office expenses, or maybe for your business library, books for your library, continuing ed, what have you, minus what is personal expenses, and that portion would be recorded to owner's draw. So it's not even part of your P&L on your business, okay? So a lot of times people will say, oh my gosh, I didn't have my personal account, so I just used my debit card on my business account. I did it by mistake. How do I account for that? You account for that by putting it in owner's draw. I'll break that down for you in a minute. Okay, so if you have QuickBooks, QuickBooks is the accounting software that I personally recommend. I am biased, though. I am a QuickBooks Pro advisor, but the only reason I became a QuickBooks Pro advisor, which just means that I'm on QuickBooks website along with a zillion other accountants, as being able to teach about QuickBooks, have clients where I do their books in QuickBooks. But the only reason I became a pro advisor was because of how much I believe in this as the best software for therapists in managing their books. It's not easy necessarily until you've learned how to do it. It's not intuitive, like you can't just get QuickBooks one day and be able to do it easily. You do need some training in it, but that is the software that I recommend. Unless, I'm just going to give you a little caveat, unless you are connected with a service, and there are accounting services out there, bookkeeping services, that they recommend their own software, but you also are not involved with it. So they do your accounting or bookkeeping through their own software, or one that they choose. And that might be different than QuickBooks, but you don't have to worry about that. But for the small business owner who's going to be in control of their accounting, I do recommend QuickBooks. But this is how you would set up owner's draw. Owner's draw would be part of equity. It's owner's equity in the tax return, and we call it owner's draw. And so that's how you would set up that new account. Okay. I did have some people saying, hey, listen, I set up owner's draw in my accounting software, but when I printed a profit and loss statement, it's not there. Where do I have that information? Well, you're right, it's not there because it's part of the equity, which is part of our balance sheet. Okay, now there are many people many therapists who have private practices who don't have any kind of formal accounting system. And if you are among that group of people, usually it's further, those people, some people use Excel, and some people just don't have any accounting system other than their bank statements through their separate business checking account. No problem. But if you're working with that, you're probably not worried about if you don't have even Excel or an accounting software system. Just make sure that when you're going through your financial activity each month, that you're not including on your calculations any personal expenses that you've run through your business. I don't like that to happen anyway, but just make sure you're not including those. But for the group of people that don't have an accounting software program, but have Excel, and I've met a lot of therapists who have some really sophisticated Excel programs. For the most part, I don't think I've ever met someone who does their accounting on Excel who also has a balance sheet. So that's okay, kind of. But if you're keeping track of your business income and expenses simply through an Excel spreadsheet, remember that's not an accounting system, but it is a somewhat of a system. Do not include any personal expenses or withdrawals of any kind on this spreadsheet. So this spreadsheet, this is just a really simple, it's just an image from Google, right? Of a really summarized income statement. So it's sales minus cost of sales minus other expenses to get your net income. There is no place on this Excel spreadsheet that personal expenses would be part of this. All right. Now, another thing that's really confusing is that you would also not include on this spreadsheet any estimated taxes that you pay on your business, and you would not include any retirement contributions, because these are not deductions that you would take on your business tax return. So even though the taxes that you pay are on your business, like you're paying payroll taxes on your business, even though those are taxes that you're paying, you would not include this as part of your Excel spreadsheet, because you are not including the taxes as deductions on your business tax return. Okay. If you're going to deduct expenses as part of your business deductions, do not include it on your P&L. In Excel or QuickBooks, paying taxes and making retirement contributions are not to go on your income statement. Okay. So I hope that's clear. Now you can take the money out of your business, but that would be put towards owner's draw. So let's just say that you're going to make an estimated tax payment of $1,000 for quarter 2. So you owe $1,000 on, and you're making that estimated tax payment. Remember, because it's all going through as a sole proprietorship, it's all going through your personal tax return. You're going to take out $1,000 out of your account as owner's draw and pay your taxes that way. So you will not see on this Excel spreadsheet a line item that says taxes, because that is not part of the deductions on your business tax return. I hope that's clear, but you can ask me questions if it's not. All right, so we want a pure profit and loss statement that is only related to your business. So that means gross income. If you're a SimplePractice customer, you would include your SimplePractice income. So any income earned that is not recorded on SimplePractice, plus any income that is received on your personal accounts. Now, several times people will maybe contract with an insurance company, get paneled on it with an insurance, and start accepting payments from the insurance company before they have established a business bank account. I know some people have told me, hey, I watched your webinar and I didn't know that I should have a business checking account, so I created one. But your insurance company is still paying you on your, and it's being recorded and deposited in your personal account. Make sure that you account for that by, like, what would be cleanest would be to take any deposits that you get in your personal account that relate to your business, would be to transfer them over into your business. So it's like a weird circuit that you would be going from the insurance company to your personal account over to your business account, but that's how you will record the income. However, I would highly recommend that you talk to the insurance company and make sure that you change the account from not personal any longer to now that business account. So it's just directly and clean. So your pure business profit and loss statement will be a deduction of business expenses. So those are things that you're allowed to take on your business tax return, and that will equal your business net income. So your taxes and retirement, again, your retirement contributions are not part of what you report in your business section of your tax return. Okay, do owner's draws count as write-offs when self-employed? No. This is why owner's draw is not an income statement item, because those owner's draws have to do with just personal items, right? Those are aside from what you're taking out for your pay, that also is not part of your tax return. So your owner's draw doesn't have anything to do with your taxes because it's not on there. How can I pay myself from my practice? Okay, so whether or not your practice is your full-time job, where your family's personal budget depends on your private practice, either in full or a portion of your personal budget, or whether or not you just have a side gig, not just, but if you have a side gig where this is not your full-time job, you may even have another or a full-time job as an employee, or you might just, this is your side gig, right? No matter what, the way you pay yourself as a sole proprietor, I'm going to add an LLC, but not an S corp. The way you do that is the same, but how much you take from that may be different. Okay, well, it will be different. All right, so like I said, it's really tough to talk about business finances without also looking at personal finances. So why are you in business in terms of what are you hoping to have your business contribute to your personal finances? Sometimes people set aside, like they might, especially for married couples, they might talk about, okay, for your private practice, I'm hoping you will take over this portion of our spending. So in order to do that, you have to know where your spending is. So this is just a really, really one slide, quick and dirty summary of make sure you have some kind of system for looking at your spending on your personal finances. Okay. Now I do happen to be a Dave Ramsey. I think my title is Master Financial Coach because I went through all that training program, but I do really love the basic foundation of what Dave Ramsey teaches. This is one of his recommendations for budget percentages in terms of personal finances. I don't know if I totally agree with that allocation. Other people recommend, it's called a 50-30-20, where you do 50% of your personal spending towards your living expenses, 30% towards discretionary spending, and 20% towards savings. Now, let me just say that 20% towards savings, that's for personal finances. I personally think that's way too low. However, that is not what I recommend for your business spending percentages, okay? So this is just a really, really one slide presentation just to say that it's important to look at if your spending, both personally and in your business, is matching your values. So just like when we work with our counseling clients to say, does your behavior match your values? And when it doesn't, when your behaviors don't match your values, that creates dissonance, right? It's the same exact thing with personal finances. When your spending doesn't match what you value, why? Let's see if we can get them in connected. And particularly this comes up with problems when there's the issues of debt. Now, zero judgment on debt. If you listen to the experts talk about, the percentage of people who have to declare bankruptcy because of medical emergency, they had some medical emergency in their family and it bankrupted them. That's a huge percentage of the people who have to file for bankruptcy. So these things happen. So there's no judgment about that. But when you're really focused on getting out of debt, you got to, then there is the difficulty with matching your values with your spending because you're so focused on getting out of debt. I want you focused on getting out of debt. We want to make sure we also are stopping the bleeding. Okay. All right. So what factors determine an appropriate amount to draw per month? All right. So my first question would be, what was your net income last month? So how much you pay yourself in this month is based on how much you earned last month. If that's consistently how you measure it, then you're going to avoid a lot of trouble and trouble equals taking out more than you should and then having a disastrous time what I'm trying to prevent is April 15th coming. You find out you owe so much in taxes and you don't have anything saved for it. So first of all, it's going to be a net amount. It's not going to be exactly what you earned last month. We're just going to figure out what you have earned in the previous month. This is my recommendation. And to put 40% aside for taxes and retirement, okay? If you have a retirement plan on your business private practice, and you get to have a retirement plan on your business private practice, you can, depending on your plan, you can save a lot of money that's right off the top. So, like in some plans, it's called a salary deferral. Like I'm talking $20,500. And if you're over 50, it's even more than that. That you can take right off the top. That's $20,500 that reduces all of your business income taxes. You still have to pay payroll taxes, but it reduces all of that. So I want you putting 40% aside for taxes and retirement. I want you to retain to keep 10 to 20% in the business. Definitely want more than 10%, but I will put 10 to 20% if you can. And then what you pay yourself, remember, we're only talking about salary when it's related to S Corps, but what you're paying yourself, what you're taking out as owner's draw is going to be about 40%. I want to give you a couple examples. Okay, well, first of all, let me just give you a couple of rules. So if you pay yourself a net amount, so first puts funds aside for taxes and retirement. If you can create the mindset that that's not even available for you to have exactly what you've earned the month before, you have to have a net amount. Just like you have a net amount when you have a gross salary, you have amounts automatically taken out. For taxes, it's the same exact thing. So you retain a percentage in your business for slow times. That's why I want you to retain 10 to 20%. So if you have not earned it, you can't take it out of your business. I did see several questions where, what if I pay myself more than I've earned? You can't pay yourself more than you have earned because you can't take out more than the cash that you have in, but you also can't take it out more than you've earned when you have to put money aside for taxes. Okay, so be specific on what personal needs are for your business to cover and back into the income you need to earn. That's kind of complicated, but I have an example that I think will really outline that. Remember, we really want to be budgeting for our personal finances. We don't want to strap our business so much that there's so much pressure on our business that we are not making the best clinical decisions in our business because of the stress from our personal finances. This is an accountability plan. Okay, so an example of backing into business goals. Many therapists that I work with have worked out an agreement when there is a family involved, like a spouse, marriage situation or partnership of some kind, where it is agreed upon that a certain percentage or a certain dollar amount of your private practice will go towards personal finances. So this is the example that I've seen. How much money do you need monthly for your personal budget? So let's use an example that you need $1,500 per month, and that is going to specifically cover your children's education. Okay, so your family has decided that what your obligation is in your private practice is to pay for your children's education. That means $1,500 per month has to come out of your business practice as owner's draw. Okay, so if $1,500 is coming out, that equals 50% of what your income needs to be. Because remember, we're putting 40% off the top of that for taxes and retirement. And in this example, I'm using 10%. We're going to retain in the business. So that leaves us 50% that we have. If you divide it by 50%, that means that I have to earn $3,000 of business net income. So that's net of my business expenses. Now, $3,000 divided by, let's just say your clinical practice rate is $120 per hour. then that means that you need to have 25 client sessions per month in order to cover you to have an owner's draw of $1,500. So 25 sessions per month divided by 4 weeks is you have to have about 6 or 7 sessions per week. Now, that doesn't sound like a lot if you're in a full-time practice, but that's only to cover $1,500, right? My guess is if your private practice is full-time and you are 100% relying on it, $1,500 is not going to cut it. So that's a way to back into how much you need to bring into your business. And that's why I call it an accountability plan, because you are backing into how much you need to earn. So if you've only earned $1,500 in your private practice the month before, you can't take out $1,500 to cover your children's education. So it's an incentive program where you kind of have to say, okay, I got to figure out ways of bringing in more income in my business. If your business is your only source of income, what are your personal monthly needs in order to back into what your necessary business income is? So every business expense that you have reduces your business net income. So when I say $3,000, that means $3,000 of business net income. So that doesn't mean gross income. That means net of your monthly business expenses in the month before. So let's just say you have rent of $500. So you have to at least have gross income of $3,500 to cover a net of $3,000 of business net income. And rent, even if you don't have rent, I mean, that's not the only business monthly expense you have. Okay. So that's why every business expense, you really need to do an evaluation if that business expense is worth it. All right. When I meet with my therapists who would like to consult with me, there's a lot going on in the background with me, and I'm watching for imposter syndrome. So this is what psychology part of my presentation comes in, the counseling part. The degree of imposter syndrome that you feel, I mean, I think we all feel it to some extent, is really important, because usually if it's severe imposter syndrome, I'm usually seeing two things. One is you feel like you don't deserve it. That's the whole definition of imposter syndrome. You don't feel like you don't deserve the success of your business. And so there are going to be some things that I'm going to watch for self-sabotage. And the other common thing that I see is that you're going to have increased business expenses around consultations and trainings. I mean, I'm mostly preaching to myself here, because I think you've probably heard me say many times that I suffer from certificationitis. It's like, just one more. I remember somebody asked a photography expert, how many lenses do you need? And he said, just one more. And so if your business expenses are really high in certain categories, that tells me certain things about what you're contributing and what is really not working for you in your business. So one of the best things that I have found to kind of beat imposter syndrome is to be really specific in whom you're serving and how. One of my greatest indications that imposter syndrome is high and mighty is when I see clients, well, they're my clients, but therapists who want to serve everyone and in every way. Okay, so really niche down, get that elevator speech, great. Figure out who you really do want to serve and what kinds of therapies you really want to provide. All right, is it better to pay myself once monthly, or may I pay myself more often? Okay, so my best advice on this is be consistent and not reactive to personal financial emergencies or stress. So you really need to have a system. So most companies pay every other week, or sometimes some will pay once a month. That's a really great strategy. What I really don't want you to do is, oh my gosh, I had no idea that personal bill was going to come up. That's an emergency. I need to take money out of my account. I don't want you taking money out just to meet some personal expenses. I want you to have an actual system where you take a certain amount out. Now, do I take the same amount out each time? I got a lot of that question. You can only take the same amount out every time if you have earned enough to be able to do that and also to have put it aside. So if you haven't earned, if you had a slower month the month before, you can't take out the same amount. So you're going to have to adjust it. Okay. Huge topic. Okay. And I know we're getting close on time, but okay. So S corporations has to do with, it is a tax filing status. So let me just break it down. Partnerships and sole proprietorships are simply run through your personal tax return. I go like this because it's personally run through your personal tax return. All right. So you pay taxes. You pay both income taxes and payroll taxes. What's really hard to kind of accept when you start your own private practice as a sole proprietorship is that now you pay 7.65% in Social Security and Medicare as the employee and as the employer. So you get 15.3% socked to you in payroll taxes you have to pay. And then you also have to pay income taxes, okay? An LLC is called a limited liability company. That is simply a legal status. All right. So that is a legal status where it has nothing to do with taxes other than if you are an LLC, you have to decide if you're a single member. If you're a single member LLC, you're still running your payroll. You're still running your business net income through your personal tax return as an LLC. All right. The difference between a sole proprietorship and an LLC is that you have that protection from litigation from your personal assets. So an LLC is something that's a legal status where if your LLC were to be sued, they can't go against your personal assets. Okay. So if you're a sole proprietorship and your malpractice doesn't cover it and you get sued and your malpractice doesn't cover the cost, like it's more than the what have you, you are at risk with your personal assets. I have yet to hear of any therapist losing their home because they've been sued more than their malpractice insurance. It may happen. I don't know, but I think the risk is super low. Now, there are certain instances where I absolutely say you should be an LLC. Certain situations where I want you protected, like if you have employees, if you have somebody, if you have associates working under your license, I think that's a deal breaker. You have to be an LLC. I'm in California. In California, I can't be an LLC. There's certain service organizations that cannot be an LLC. So I don't have that option to be an LLC. What I do have an option, though, is to become an S corporation. Okay, so this slide cracks me up because originally when I made this slide, I called it pro and cons because I only had one pro for being an S corporation. In my experience, which is like, I do have to say, there are many different opinions from CPAs about S corporations. In my educated experience, though, most therapists become S corporations simply because they've heard you can save in taxes. And that is not untrue. However, they don't understand what they have to do in order to save taxes, and they don't do it properly, and you can get in big penalties and incur a lot of expenses if you don't do it properly. Okay. And to me, it's not worth it. And the whole idea behind an S corporation is, as an S corporation, you are now taking a salary. So you have to do payroll. So you're not paying yourself through owner's draw. You are paying yourself through salary. And most accounting firms won't even take on doing payroll because it is highly like IRS is like massively looking at the red flags with payroll because so many people do it incorrectly. about this. In order to be an S corporate, people want to be S corporations because they can save on payroll taxes, not on income taxes, but on payroll taxes. And the reason you can save on payroll taxes is outside of taking a reasonable salary, anything else that you take above and beyond your reasonable salary is not taxed on payroll. Okay. However, in my opinion, it's really tough for you to convince me that whatever you're making outside of your business, in your business, that's usually your reasonable salary. So reasonable salary is this, it's in quotes because the IRS cannot say with every different company what a reasonable salary is, or every different industry, because it depends on the industry. It depends on the way you've set up your practice. It depends if your practice is full-time or not. And so reasonable salary is an ambiguous term. However, the way I define it is if you were to go on a year's vacation and needed to hire a replacement, a similar level replacement to your license and everything, and to take over your business for a year, what would you pay them? And it's really tough for you to convince me that if you made $100,000 in your business, your reasonable salary is only $40,000. And that's exactly what most people do, is they take $40,000 as their salary, and then that $60,000, that's the difference, that is not taxed on payroll taxes. It's still taxed on income taxes, still flows through to your personal tax return, but it's I think you're going to be in trouble. Now, having such a low salary, like if in that example, if you had $40,000 in your salary, also might not be working for you, because you might be applying for a loan and they want to know what your salary is. Well, if your salary is only $40,000 because you took such a low salary, is that going to work for you? Also, if you're taking a low salary, that means you're paying lower in payroll taxes. That means you're paying less into Social Security and Medicare. Does that work for you? I don't know. Is that part of your retirement plan, is to be able to take less out in Social Security and Medicare? It may be. I don't know. But taking a lower salary is not always your best option. As well as in California, if you're an S Corp, you have a $800 minimum state tax payment that you have to make every year. And that's just because you are an S Corp. That doesn't have anything to do with how much money you've earned. So you also have to follow documentation requirements and filing fees. That filing fee in California is $25. But I have seen people miss that filing fee because it came through on an email, and now it's $250. So there are some real downsides with being an S Corp. Like I said, it's a very controversial topic. Most CPAs do not feel the way I do, so I do have to give you that caveat. But Cheyenne, okay, I think I've covered that. It's only a salary when you have payroll involved, and payroll is only involved when you are an S Corp. Let me just really quickly. I think I've gone through this. The benefits of being an LLC over a sole proprietorship are that you are protected more. The benefits of an S Corp versus an LLC or sole proprietor is that you can potentially save in payroll taxes. But let me just also add that caveat, because I didn't warn you about this, is if the IRS were to say, no, that is not a reasonable salary, the penalties that you are assessed are significant. Most CPAs will say that risk is very low, but I don't like to take any risk. All right, so I do want to give you that information, but I do have to say that I had to change my script to say I'm no longer allowed to say, it's a personal rule, I'm no longer allowed to say, hey, if you have any further questions, please don't hesitate to email me, because I'm still have a backlog of email I'm still working on that backlog from my last webinar, and that kills me that I haven't been able to get to people. So I'm sorry in advance. I would like to encourage you to be part of my Bob monthly support group. You can ask lots of questions there, and you don't even have to email me. I get back to you right there because I'm watching you. I'm hearing the questions. So, all right, Cheyenne, take it away.
This question is from Jonathan. Is the payment to myself that is beyond my reasonable salary made through a member draw?
Yes. But remember, just make sure that that reasonable salary is really reasonable. So yes, technically that would be going through as owner's draw, member's draw. Yep, and that is correct. Now, I have seen people that, like, sometimes even accountants allow you to do this, which I just don't like. It's just not clean. And sometimes people throughout the year just keep taking owner's draw as S corps, and then the accountant does this magic. That's also, in my opinion, that's a no-no. What I mean, they did this magic. They gross up those withdrawals as a larger gross salary. And but the IRS is only getting that tax payment at the end of the year, and they don't like that either. So I do not like that. But yes, above and beyond your reasonable salary is accounted for through owner's draw.
Great. Then our next question from Leticia. Do all S corporation rules apply to me if I am an LLC, but I'm taxed as an S corp?
So So yes, all S corp rules apply to you as an LLC and S corp. So when you are an S corp, you in effect are an LLC. I mean, we can't be an LLC in California, so that the only way we can be a LLC is to be an S corp. So if you're an S corp, you are also the same benefits as an LLC. It's just that you now have to take payroll. So yes, the rules do apply.
Okay. Next question we can take from Leah. When a single member LLC practitioner goes on parental leave, are they allowed to do owner's draws during their leave?
Sure, because remember, an LLC practitioner, I assume you're not saying an S corp, an LLC practitioner still, that LLC has nothing to do with taxes. It's you're probably still a sole proprietorship, or you're an LLC. It's called a single member LLC. It's still run through your personal tax return. If you're taking draws, hopefully you have a lot of retained earnings before that. So you can't take more than you've actually earned. And I really want to make sure that you don't take, you first take 40%, 50% if you're in California, 40% aside for taxes in retirement. But then, yeah, if you have it in your account that you've already earned it, yeah, definitely you can take it as an owner's draw.
Great. Our next question is from Bonnie. What about when you're making a payment on your business credit card? Would it be listed as an owner's draw?
If you're making a business payment, okay, sorry. If you have a business credit card and you make a payment on that, you've just paid. So your business credit card accumulates expenses, right? So you've put those expenses. Let's just say you don't have an accounting software. You put the expenses from your business card onto your Excel spreadsheet, or you're accounting for the expenses that way. And then your payment is just a payment off of that liability of the credit card. The credit card account balance is a liability account. So let's just say you owed $500 on your credit card. When you pay it, your cash is reduced. So your cash is credited and your liability account is debited. That you don't need to know about debits and credits, but what you pay on your credit card is not considered owner's draw. It's just a payment off of your credit card, but any expenses that you incur on that card should be accounted for as part of your profit and loss, any business expenses. Okay.
Got it. And we'll take one more here. Would that mean that you can draw straight from the business account to a retirement account?
You can draw straight from a business account to a retirement account. So let's just say you're going to make a contribution to your retirement account. You can take it out of your business account and it's considered an owner's draw, and you can contribute it to your retirement account. I would like to say that you want to make sure you don't contribute more than your maximum. And for the retirement contributions, what I do during the year is I just hold it, and I don't pay it. And then when I do my tax return, February, March, April, I find out from my tax return program or my CPA how much I can contribute to my retirement account, and then I make that contribution before I file the return, before the due date and everything, so that it's still, so I don't actually pay on my retirement account into my retirement account until the end of the year, but I want you setting aside those monies. And so to set them aside, I recommend having a dedicated savings account to do that. There's something else I was going to say. Oh, I know. I got a lot of questions on how do I pay myself? Like, do I have to write myself a check? You do not. You do not have to write yourself a check. You can simply do a bank transfer. If your bank account is the same bank as personal and business, and just simply do a transfer. But remember, be consistent. Like, have it where you do withdrawals like twice a month or once a month. Don't make it just like, oh, I need money, so I'm going to transfer money over. That's not the best practice, like I've gone over.
It looks like we might have time for one or two more.
Okay.
We have one here from Heather. If I used $1,000 as seed money to start the business, can I later take out that $1,000 from the business account as an owner's draw?
Yep, absolutely. So that initial contribution of $1,000 is considered owner's investment. So that's increasing your owner's equity. And then when you take it out, it's just an owner's draw. So it's just, yep, perfect.
All right. Well, thank you all again so much for joining. As a reminder, be sure to sign up for Pollen. And thank you so much, Edie, for being here today. We really appreciate it. Again, everyone will be sent this recording, and we'll make sure you have the full video. So thank you so much for being here with us today. Thank you, Edie, for being here as well.